Today, I want to talk about something that could significantly change the way you think of your financial future: overfunded whole life insurance. Now, you may be wondering, why should I consider putting any of my money into this? And I'm going to share with you 5 core reasons why people that I've worked with directly have decided to do just that. And I want you to consider this in light of a comparison, or in light of comparisons, because really, that's a natural thing that happens in our minds anyway. Whether we realize it or not, we naturally compare decisions that we make to things that we already know. So let's dive in and let's see how overfunded whole life insurance stacks up. First up, we have safety and liquidity. We've all heard this saying, don't put all your eggs in one basket. And that could not be more true when it comes to your money. And it seems to me that so many people, probably even too many people that have the ability to save for the future, tend to just kind of resort to putting money in the market. And I'm not the type of person that says that's a bad place to put money. Knock yourself out. I think it's good in many cases. But I do think it's kind of foolish to not have some element of safe and non-volatile assets within your portfolio, especially for long-term savings. All right, so quick pause. I realized that as I was editing this video, I used the word foolish within the presentation. And ultimately, I don't want you to feel like I'm calling you foolish by any stretch of the imagination. When I was talking through that, I was thinking to myself about, given the value set that I have personally and the things that I've learned up to this point in life, I think it would be foolish for me to do what I was kind of talking about in terms of putting all my eggs in one basket. And so with that said, by no stretch of the imagination am I calling you foolish. I just wanted to over communicate that fact. That's by pausing this video. And ultimately, I stand by. It's not, for me, the smartest thing to do, but I'm not going to say that anyone who does what they believe is best for themselves at that point in time is foolish for doing so. I just wanted to over communicate that. So back to the video. Whole life insurance also has additional benefits like tax-free cash value growth, death benefit, which is tax-free. And then when you think about bonds, on the other hand, they're still going to be vulnerable to market fluctuations and even potential losses. So with overfunded whole life insurance, you're going to be sheltered from all of those sorts of risks. All right, next up, we have uninterrupted compound growth. And let's compare this to traditional banking options, right? So bank accounts typically offer an internal rate of return, or IRR, somewhere in between 0.5% and 1%. And I think that may be a little bit generous, right? And the term internal rate of return, that in and of itself might require its own video. So kind of stay tuned for that. But anyways, compared to an overfunded whole life insurance policy, the internal rate of return is going to be somewhere closer to 3.5% to 4%. Right? So once your policy matures, you could even see growth somewhere closer to 4 to 5% from an annual basis, like year-to-year basis. And when I'm talking about all of these rates of return numbers, I'm talking about after expenses, right? These are net numbers, which is really powerful to understand. And even better, your money is going to continue to grow as if it were never touched, even when you borrow against your policy. That's because when you take a loan against your policy, that is actually going to be coming directly from the life insurance carrier's general account. And so even if you never pay off the loan, which I'm actually not a big proponent of, especially early on in the policy years, your death benefit, which is typically going to be significantly higher than your cash value, is going to take care of that. So this means that your growth never stops, hence uninterrupted compound growth. The third reason is supplemental retirement income and true asset class diversification. This right here is why I personally started putting money into a whole life insurance policy some years back, and why I still continue to put money into it to this day, because I tend to think pretty long term. And I had a sneaky suspicion even back then that only putting money into the stock market, for example, is probably going to be a bad idea, right? And so this word diversification kind of gets thrown around a lot by money managers. I'd say it's even been like hijacked to some degree. But true diversification isn't just having a mix of stocks. It's about holding assets that behave completely different from one another, right? Overfunded whole life insurance, it kind of serves as the safety component, or directly serves as a safety component, just like we discussed earlier, right? And then it's going to be a part of your overall retirement nest egg. Now, the market or stock market, it's always going to fluctuate pretty much. And that's just because the emotions and behavior of people tend to always fluctuate as well. But with a stable asset like whole life insurance, you have something that you can tap into when the market takes a downturn, especially during a retirement income phase, right? And so this allows your market-based assets like your 401ks, IRAs, things like that. It allows those assets to recover without being forced to take withdrawals and taking a loss and all of that, right? Now, the key here, though, the key is to have a significant enough safety net. If you have $1 million in the market in 401ks and this and that, and you have $50,000 in the safety component, let's call it life insurance, it's not going to do you much good over the long haul of your retirement. So just throwing that out there as well. I think it's important. The fourth piece here is leverage, or as I like to call it, a private line of credit. So loans from a whole life insurance policy are essentially unstructured lines of credit where any adjustment to the principal directly impacts the interest charge. So this is invaluable for real estate investors, business owners, or anyone else looking to save money while still wanting to grow their wealth, okay? So with a policy like this, you don't have to choose between saving and investing in your business. You can literally do both at the exact same time. And depending on kind of the timing of economic conditions and things like that, the interest rate on a policy loan could be quite a bit lower than what you'd find at banks or credit unions as well. Plus, the repayment schedule on these policies is incredibly flexible because there isn't one. There literally is not a repayment schedule. The insurance company knows that they're going to get their money back at some point because you'll either repay the loan, and even if you don't, it's going to be covered by your death benefit, okay? Now, finally, let's talk about legacy. I think this one can sometimes be slept on, as they say, in many ways within the community that I work in. And so specifically what I'm talking about here is the permanent death benefit. So the amount of wealth that you can transfer to people and organizations that you care about is significantly maximized with life insurance. So imagine if you had the ability to save $1 million and you've been working your entire life to save this $1 million and you want to give that to your kids, grandkids, church, charity, whatever. If you have, first and foremost, if you manage to save $1 million, that's amazing. Like, kudos to you. Not many people can do that, period. But what if you could turn that $1 million into $4 million, $5 million through a well-structured whole life insurance policy that's permanent? And the best part here is it's not even going to cost you $1 million to produce that kind of legacy. So this means that you can maximize the impact that you have while you're still here, and even more so after you're gone. So kind of gone are the days of stockpiling cash to hopefully leave something significant when you die. So there you have it. The 5 core reasons why overfunded whole life insurance is a strategy worth considering. It offers safety and liquidity, uninterrupted compound growth, supplemental retirement income with true diversification, flexible leverage, and it's a powerful legacy tool. It's about protecting what you've worked so hard for and ensuring it continues to grow and provide for you and your loved ones for the future. So if any of this resonates with you, consider speaking with someone who specializes in setting these policies up and who can help you tailor the strategy to your specific needs. And if you found this video helpful, don't forget to give it a thumbs up, subscribe for more financial and life insurance insights. And if you want to know exactly what type of whole life insurance I've been talking about, click this video here. See you next time. Thanks for watching.